Over the last 20 days, I started a brand new portfolio with $15,000 and grew it by $1,500. Now I'm going to break down step by step how I did it and what's the plan moving forward. So I'm doing this basically because this was something I wish I had more than 7 years ago when I started investing. You see, although I tell people I started investing 7 years ago, right? The truth is, 7 years ago, all I did was just study companies, and then I sat on my hands for one whole year.
One eternity later.
Before putting a single cent into the market, just because I didn't know how to start and where to even begin. And then when I was asking around, people on Wall Street or some financial advisors that I know basically was speaking in finance lingo that I could not understand and make everything seem even more out of reach. You see, what I wanted was not someone to tell me what to buy and sell, but how they come to their decision and to understand the thought process between them picking different companies. Why can one investor choose to invest in Amazon over Google? However, another investor can look at the same two companies and choose to invest in Google over Amazon. And what I needed was someone to be able to break it down into plain, simple English that a normal, busy human being can understand and take action on. And of course, that is what I hope to do through this series. You see, for me, when I started investing, I started with Singapore markets before moving into the US markets and eventually combining both the US and China markets. Now, at a point in time, right, I was actually managing a position where I had more than 15 to 20 companies in my portfolio, and that was really, really tiring before eventually scaling down to a portfolio of only about 7 companies. And from there, I started to explore different ways of generating income from my portfolio using different option strategies like the wheel strategy and buying spreads. And truth be told, I'm actually quite thankful that I did pretty okay in the markets in the last few years because I actually entered into investing without a strategy, and I basically did it quite haphazardly. Every time I would learn a new strategy, I would just throw a couple $1,000s at it, see what worked and see what didn't. And so my style of investing has been quite experimental over the years. And I think the good thing that came out of this, right, was that I was able to tell you how each of these strategies work and some of the risks that are associated with performing these strategies. However, I wasn't putting them into a coherent plan that someone can take action on in a very, very systematic way. Which brings us to this portfolio. You see, when I first started investing, right, I had this romanticized idea of what investing is, to learn all the different strategies so that you are able to perform the best in every different market condition. However, the truth is investing doesn't need to be that complicated. And so after years of learning and failing and trying to dip my toes into the water, making a ton of money and also losing a crap ton of money, I'm here to basically trying to streamline my own investing process and to do the most important thing, which is to make money. Because it doesn't matter how much I know, how complex the strategies I employ, because the last I checked, no matter how much I know, I can't exchange a single strand of this knowledge for a plate of cai fan or my kopi peng. So the objective of this portfolio is very simple. I only have 3 objectives. The first one is the most important one, which is we want to beat the S&P 500 returns over a 5-year time horizon. So this starts from 27th June 2024 onwards, and of course my brokerage actually does give me a way to track my portfolio's performance against the S&P 500. However, I don't think it's the most clear way, but the screenshots from there will have to do for now until I find a better way to track the progress. And secondly, this acts as my own personal investing journal, and the reason why I actually need a journal is because I have all these things that are jumbled up inside my head, all the things that I've learned over the years that I want to actually put them together to come up with a coherent and systematic investing strategy that I can replicate consistently. And the third objective is basically to practice what I learned in my CFA. You see, after years of banging my head against the wall and trying to go at it alone, I finally decided to register for the CFA, and basically I'll be using this portfolio to practice what I learned during the course. And so as I manage this portfolio, right, I really want to give myself some rules and some guidelines to follow so that I have a decision-making framework moving forward. The first guideline, which is also the most important, is that the majority of this portfolio has to be focused on long-term investments, and I'm going to be using an 80-20 split, which means at any point in time, 80% of the portfolio has to be allocated to our long-term investment strategy, and only 20% can be used for opportunistic investments. Now, opportunistic investments are things like Meta at $88 a couple of years back, right? And so basically, if you want to participate in some of these asymmetrical opportunities in the market, you don't want to be caught in a position where you're forced to sell your core holdings. So you always want to keep some dry powder at the side. And why 20% is basically a form of risk management. We only have a very small portfolio, and that's something that I'm not willing to blow up my whole portfolio just to participate in this asymmetrical opportunity. And the second guideline I want to give myself is basically to not invest in more than 4 companies for the very simple reason that I can't keep track of any more than 4 companies in a very efficient manner. We want to know the companies very well. We want to be able to follow the earnings reports of these companies. And so this is something I'll be looking to work towards. Now, I'll basically be focusing on companies between the 5 to 30 billion market cap, but that's not to say that if the company is any bigger than that, we are not going to invest in it just because it has a big market cap. We'll be looking for good investment opportunities. But in general, we'll be looking for businesses with proven business model that are in the scaling phase. And usually you find a lot of these companies in the 5 to 30 billion market cap range. So we are not going to do penny stocks, and we are also not going to do any biotech stocks because to me at least, I think that's the easiest way for you to light money on fire. And if you have so much money that you want to light some money on fire, you can look for me because I can tell you many other better ways to light your money on fire. So the third thing I want to actually focus on is to only run 2 different option strategies, which is the wheel strategy and vertical spreads. Now personally for me, I'm more comfortable with the wheel strategy than vertical spreads. Vertical spreads are still something that is fairly new to me, something I'm actually trying and starting to get the hang of. And so basically that will only be done usually during opportunistic trades and not for my long-term investments. And basically, I use the wheel strategy to generate income on my long-term investments. And the fourth thing is basically, this is not a trading portfolio. We don't do day trading and things like that. We don't do Forex. We don't do CFDs and futures. And I also don't short companies usually. The most I'm willing to do is to buy a put on the company as a hedge, but that's about it. I do not short any companies. So this removes a whole bunch of complexities from the investing process. And if you have no idea what I just said, right, that's perfectly fine, because all these things you don't really need to know in order for you to do well in investing. Just a quick disclaimer, right? You see in my previous investment portfolios, right, because I had a larger capital, mistakes aren't as costly, so I was able to experiment a little bit more. And at the same time, I don't have to be so efficient in allocating capital, and I was always having a bit of dead money in the portfolio. However, in our current situation with this small portfolio, you basically only have two options. Number one, either you take on a second and third job so that you can actually put more money into the portfolio to grow your investments faster, or you grow your knowledge so that you can take advantage of the knowledge gap between you and other investors to grow your capital even faster. Which is why along the way, although we say we focus on long-term investments, there may be times where I will want to look to take profits from certain investments and to reallocate the capital more efficiently. Finally, right, I actually do have funds tied up in other brokerages as collateral, and once those option strategies expire, I may look to move some of the capital over here so that we can actually increase the sizing of this portfolio so that we can actually run different strategies moving forward. And so basically, right, this is me documenting my process of trying to beat the S&P 500 and give you a behind-the-scenes view of my investing thought process and basically act as my personal journal. Now, what this is not, this is definitely not financial advice. This is not buy and sell recommendations, and this does not substitute your own due diligence, because this is basically just one person's perspective among a sea of others. And so you do need to do your own due diligence on the companies that you plan to invest in. So, right, basically, as you can see here, right, on the 27th of June, I put in 21,000 SGD, which actually amounts up to about 15,500 USD. So later I can show you how to work backwards to get that number. And so basically, the other deposit you see here happened in 2021, 2,700. That one is because Momo had their promo during that time, right? You put money in and then they give you some shares and things like that. And then just to show you, under the withdrawal, right, you can see I actually took out the 2,700 that I put in, and then you can see I withdraw a couple hundred extra dollars, because those actually are basically from sale of shares of certain companies that I got from referring people in. So that is basically the only transactions in this account, and this is the clean slate that we are starting from. So if you take a look at this screenshot, right, the total assets it puts here $17,046.70, and then just below that the P&L trend, basically the P&L is about $1,593.49 over the last about 20 days. So you consider that this portfolio started on the 27th of June, so that's about in a 21 days time we made about $1,600. That's not too bad, so about 10% return during that time. But if you look at the current P&L, it actually puts there only $1,367. That's because we actually already closed out one option, realized about $200 profit. So later I'll show you that during the transaction receipts. I know basically the screen here can be quite hard to see, and so what I did was I screenshot from my phone. I have basically 3 positions open at the moment. I have an Enphase put at $105, Neo put at $4, and SoFi basically is a bank. Basically what I do is that I already have 500 shares at $6.33, and I also have sold puts for $7, and I have about 15 of those right now. And so just to show you, right, this is the history of the transaction. As you can see, it started on June 27th all the way until yesterday, right, 15th of July. Is it yesterday? A couple of days ago, 15th of July. And so basically what I want to do right now is take you through the 3 positions that I have and to tell you what is the plan moving forward and basically how I actually end up making this $1,500 from this account over the last 20 days. So the first company in the portfolio is also the biggest position at the moment, which is SoFi. SoFi is basically a US digital bank. It's a fintech company with a banking license. So I think it's quite unfair to say that it is just a bank. Now, why I like SoFi so much, right, is really because of management. Now, they have a very, very competent management team, and that really draws me to a company when I can see the management executing every single quarter. So basically what happens is this management, right, every time they set certain expectations, they always beat the expectations and raise the future guidance. So that is something I really like to see. So that means whenever they promise me something, right, I basically have the expectation that they will achieve whatever they promise, you see. And so let's take a look at what management says.
Sure. Starting with our goal. Our goal is to become a top 10 financial institution at SoFi. In order to do that, we have to become a trusted household brand name. And partnering with large, credible, well-known brands is key to that.
In line with our vision of building the AWS of fintech. So we ended up purchasing Galileo back in May of 2020 because we fundamentally believed that we needed to vertically integrate our checking and savings business in the same way that we did for lending.
The management actually tells us that they aim to become the top 10 financial institutions in the US, as well as the AWS of fintech. They are hoping to become the one-stop shop for all our financial needs, not ours, but people in the US at least, and then they may expand globally in future because they actually have a Hong Kong arm as well. So in a recent interview, the CEO said that basically in their platform, whenever you have their app, they aim to do 3 things for you. when you open the app, you know what must be done in your financial life, what should be done, and what can be done. And so basically that is the thesis for investing in SoFi, that they will become a top 10 financial institution in the US and the AWS of fintech, basically becoming a one-stop shop to serve all the needs, at least of the US citizens first, and then potentially expand out globally. One of the issues people like to talk about when it comes to SoFi, right, is like they say that there's no growth in lending, the lending is really slowing down. But the thing is, if you look at the revenue of the company, they actually still show a 26% year-over-year growth. And this lending slowdown is more of a self-imposed slowdown. You see, when they're planning for 2024, their business, right, they actually predicted that GDP will slow down, there'll be 5% unemployment and only about one rate cut. So when we look at the economic numbers today, right, we actually don't see all of these happening. We don't see the American GDP slowing down. We don't see 5% unemployment. Rate cut, possibly 1 or 2. People tend to think that September there will be a rate cut. And that is to say that however they projected their business to perform, right, is based on a weaker economy than what we see today, which actually means that because of the stronger economy, there's a higher chance that SoFi will likely beat their expectations. And in fact, when we look at their revenue breakdown, right, it's unfair to say that they're just a bank, because their financial services grew by 42% and their tech platform grew by 20%, which actually makes up 42% of the overall revenue, which is why I say you can't really call them just a bank anymore. And I always like to say that profitability really tells us a lot about the mode of the company, right? So when banks lend out money, they basically earn from this thing called net interest margin. And over the last year or so, right, we can actually see an expanding net interest margin, while other banks' net interest margin are contracting. And so when I do my research on SoFi, I like to reference to this guy, Data Driven Investing, and just nice, right? He basically has already compiled this list for me, and I'm just going to show it over here. The different banks, right, like Citigroup and things like that, they actually have contracting net interest margin over the last year. However, SoFi's net interest margin has been expanding. So you imagine as the rates come down and lending starts to ramp up, I think the net interest margin will continue to expand even more. Another thing to consider when it comes to SoFi, right, is the growth in earnings per share. So right now, this year in 2024, they're expected to make about 6 to 8 cents EPS. However, by 2026, they're expecting a growth up to 55 to 80 cents. So this is basically what management say they are aiming to achieve by 2026. And when asked about it, management actually said this will be done just by continuing to run their current businesses, not factoring in any new products. So any new products that we see from now until 2026 is basically a cherry on top. So why I'm inclined to believe what management says is because of their track record. Every time they say that they will achieve something or they aim to achieve something, they tend to do it and actually beat their own expectations and raise the guidance moving forward. And so that's what I expect when they tell me, oh, my EPS is going to be 55 to 80 cents, then I do expect that as well. And even if EPS comes in the lower end of the guidance, 55 cents, to grow from an 8 cents EPS this year to a 55 cents EPS in just 2 years, it's also quite incredible growth to me, right? So that is basically one of the bull case for me for wanting to buy SoFi. So their customer growth, in the last quarter, they actually grew by 620,000 customers, 44% year over year, and their revenue has actually grown 6 times since 2020. And while I think people were a little bit afraid of their unsecured personal loan portfolio and the default rates did tick up, I think it's still within tolerance, which is what the CEO has said on CNBC recently. And I think one of the important things that investors need to pay attention to moving forward, right, is the improvement in their tech platform. We need to see it take up a greater portion of their revenue in order for them to command a higher multiple. Basically, if you look at the position, right, the first thing I did after opening this account on the 27th of June, I basically sold 10 cash account puts on SoFi at $6.50, received 34 cents per contract. So that means I basically received $340 on the day itself. And then basically on 15th of July, I closed that out, bought it back for about $30, which means I profit about $310 by this transaction. Okay, so that's the first thing I did on SoFi. That option is completely closed already. That's why you don't see it there in the account, but it still is reflected in the overall profit. Now, the second thing I did is then on the 2nd of July, I actually bought SoFi at $6.33. Okay, because to me, that has been a very strong level of support that you can see that SoFi tends to just like to bounce around this area every time. So I feel quite safe buying about 500 shares then. I should have sold some covered calls on these shares, but I forgot. And then basically as time passed, I just didn't because it just keeps rising. Okay, and then 9 days later on the 11th of July, I sold 5 cash account puts at $7. This time round, taking a 65 cent profit, 65 cent premium. And then after that, very gain, I tahan, right? And then on the 12th of July, I sold another 10 at 64 cents. So basically net, right? If you look at my SoFi position, now I have 500 shares of SoFi, average cost of about $6.33. And then I basically sold 15 cash account puts at $7. And so far, I've received a total premium of $643 lah, thereabouts. And then now basically if I want to buy back to close, I have to pay $270. So obviously I'm not going to be doing that right now, but that is something I'll be looking out for lah. So basically once the contract value of those options get low, I may decide to roll it out even further lor, and continue getting premiums, or I may want to buy the shares at $7. So it really depends. And the second company I want to talk about, right, is Enphase Energy. Now I don't actually own any shares of this company at the moment, but I have one cash secured put out on it, basically at $105, which means I'll buy 100 shares of Enphase Energy at $105 if it actually reaches that price lah. So why did I do this is because at the moment I'm still doing research on the company. I'm fairly convinced on the company, but not 100%, maybe 75-80% kind of convinced on the company. Still a little bit of research to go, but I don't want to wait until I'm fully done with my research before I start looking at the stock. I want to participate in some of the price action. If it goes up and I actually like the company, I may not mind buying at a slightly higher prices. However, if it comes down at $105, at $101 actually, if you less the premium, right, it actually makes quite a lot of sense like at these prices. So basically what this is, right, Enphase Energy is a solar company. They manufacture this thing called microinverters. And so basically what are microinverters? You have to understand how solar energy works. So basically the solar panels, when they absorb the sun energy, the energy from the sun, right, basically they absorb it in this form called DC energy. I think we have learned it last sometime in primary school or secondary school before. And DC energy basically needs to be converted into AC power in order for our home appliances to use it lah. So there are basically two ways to do the conversion. You can either convert it using this thing called microinverters, which is what Enphase produces, or some of their competitors do this thing called a more centralized conversion. I think it's called string something. I can't remember the name. I'll go and find it out later. Give me a second. Oh, correct. It's called the string inverter. So the main difference is this. A string inverter, right, is basically where you centralize the conversion. It means all the different solar panels will come into this centralized component, and this inverter will convert all the energy at once from DC to AC power. However, for Enphase, the technology is a little bit different. The microinverters are installed to each individual solar panel, which means that the conversion takes place on the solar panel itself before it is given to your house. So there are pros and cons of both methods lah. With the string inverter, right, the advantages is that it's cheap. However, the problem is that you basically link all of it into your one inverter. So if your inverter spoil, that means you don't have solar power for your whole house already. However, with Enphase, right, when you have the microinverters, I think the good thing is that even if one solar panel is spoiled, right, it actually doesn't affect your house doesn't affect your house that much because you still have all the other solar panels working. So if you were to think about it in a very simple way, right, it's like what we learned in primary school, the batteries and light bulbs, right, when it's connected in series. If one component spoil, the whole circuit cannot work. However, if you connect it in parallel, even if one spoil, the whole series still can work. So that's how I like to think about it lah. It's very layman. That's not exactly how it works, but I think generally that's what helped me to understand what's the difference between the two offerings lah. So of course, the microinverters, having to install it individually on every single solar panel is definitely more expensive. However, that also means that Enphase has a higher margin than its competitors lah. And so one of the things that really make me like this company, right, is because Enphase is actually a very rate sensitive stock. Like nobody wants to install solar panels, take on a $10,000-$20,000 loan just to install the solar panels, and then having to pay back the loan at such a high interest rate. So whatever savings that you make from switching to solar panels, right, you basically end up having to pay more in terms of the loan. So it doesn't make sense for people. So generally, like what I was mentioning in my previous video, right, sometimes when companies want to earn market share, want to win market share, what they do is they actually cut costs. But Enphase management actually remain steadfast, and they say that, you know what, we are not going to cut costs. We are very certain about the demand of our product. We know that people will want it. It's just that now we're in a bad rate environment. So when the rates come down, our demand will continue to skyrocket. Our demand will continue to skyrocket. So basically, what they're telling us is that they believe they have pricing power, which means that their margins will continue to remain strong as time goes on. So basically, this is something we want to observe, you see. We want to make sure that even moving forward, when rates are being cut, and they never reduce their prices, demand is still there. We want to see demand pick up, and we want to see that their margin is being maintained moving forward. So when you look at Enphase, right, you can actually see that the setup really ranges. It costs somewhere between $1.10 to $2 per watt, depending on the scale of your installation. So naturally, the bigger the scale of your installation, that means how many solar panels and all that you install for your house, right, the more value for money it is. So basically, like I said, it costs somewhere between $12,000 to $20,000 to install the whole solar panel setup for your house. And as long as rates come down, hopefully people will be more inclined to install this. But naturally, if a recession comes, if the US economy hits a recession, then people will not be so inclined to want to install. Like if you're in a recession, I think the last thing you want to do is to install a solar panel and take on the $12,000 to $20,000 loan just to install the solar panels on your house. Right? So we really have to see whether or not demand picks up once rate starts to come down. So like I said, at $105 with a $4 premium, I wouldn't mind owning Enphase at $101. If I don't end up owning it here and I finally like the company somewhere at $110, $113, I think I'm quite willing to buy anywhere below $113. But again, like I said, I haven't really done my full research. This is just off the top of my head right at the moment lah. Okay, so I'll just end up selling another cash secured put, lowering my cost basis even more, and then we'll go from there lor. So the revenue growth is not bad year over year, starting to flatline a little bit. Same for the gross margins, operation margins, and net margins. So that's something we want to see improve moving forward lah. But looking at the price today is what, 18th of July. Enphase just basically crapped the bed and dropped 4% in a split second. Don't know what happens, and so let's see whether it bounces on the line right now. But this is very weird. They were really just up like 2-3% just a few moments ago as I was recording this video. So I also don't know what happened that caused it to suddenly drop by 3%. It will be something I have to look into. So the Enphase transaction here is a little bit more straightforward, right? Back on June 27th, I sold 10 cash secured puts for SoFi at $6.50 and closed it out on 15th of July at 3 cents per contract, right? So basically, after making that profit, I basically free up the collateral and I sold Enphase cash secured put against it for $105 and received $402 as premium lah. So this will basically expire on 26th of July. And the reason why 26th July, right, is because I do not know what's going to happen during earnings, right? And I don't want to be caught basically holding this position into going into earnings lah. So I want to close out this position before earnings. Now, if you look at it, right, on this screenshot on my phone, it looks like it's profitable because I basically received $402 from selling the put, but then now the contract is only worth $2.96. So it shows you that I have a profit of $109. But actually, if you look very closely, the screenshot on my computer that I showed initially, that was actually more recent. That was just yesterday, only on the 17th of July. And basically because the market tanked, right? So because when the market tanked, Enphase gets closer to the 105 price, and then the contract basically went up in value. And so basically now we are down about $10 on the contract, but we have up to 26th of July, so not to worry. And the thing is, we're still very far away from the strike price. And today, pre-market, Enphase looks to be bouncing back up. So all's good, all's good. Okay, so and then next thing we have to get to NIO. So the last company in the portfolio, NIO, right? Basically, I don't have too much of a bull case. I'm not saying that, right? I don't like this company or I'm bearish on NIO. That's not what I mean. I find it an interesting company, but because they're still in the scaling phase, and I know for manufacturing companies, especially car manufacturers, when you look at what happened with Tesla, right? It's not an easy ramp, and I think although they have the Chinese government behind their backs, I do think that I want to see a little more substantial growth in basically the amount of cars that they are able to produce before I feel more comfortable investing in that company lah. So why did I buy it? Basically, this was more of a technical entry, itchy fingers. Like I see the price looks good. Basically, selling a put at $4, getting 16 cents, which means that I'll be buying these shares effectively for $3.84, and the lowest is about $3.80. So I know, right, I confirm can use options to turn this position profitable if I ever need to lah. But that aside, I think because China accounted for 60% of all EV sales in 2023, so I think that is something that is really in their favor. And generally, their whole economy is looking to switch to EV. So generally, when you invest in China, you want the wins behind you. And when I say wins, I actually mean like the support of the government lah. And as long as it's part of the national agenda, then great. So I was attracted to NIO a while back, actually for a very lame reason. Okay, I can tell you the first time I ever heard of this company is because I heard this EV company actually has a charging station at Everest Base Camp, and I've always wanted to climb that one day. So I guess we kind of have some sort of affinity. And then I'll basically show you lah. This is the picture that I saw, and this is what got me interested in the company. But in all honesty, I think the rate of deployment in terms of its battery swap facilities and all that is really quite amazing because of its partnership with Sinopec as well. They're coming up with also newer and cheaper models, and I think because Tesla does charging, right, and they do battery swap, I think this whole idea of battery swap tends to be frowned upon by many people, especially the Tesla bull. But living in Singapore, and we are freaking small, okay, I can tell you that it's not feasible for everyone to own their own Tesla with a charger at home. I mean, for context, I live on the 12th story. So I do think battery swap has a place, especially in land-scarce nations like Singapore and many Asian countries where actually the population density is quite high, and then a lot of people are actually squashed together in these tall, high-rise buildings. So you can't expect every single person to have a charger at their home. But let's see lah. So I probably won't be looking at this position for long. As long as the option expires worthless, I may not be selling another cash secured put in this position unless I really got nothing else to do. And so the plan moving forward is basically we will close out this NIO put, we'll let it expire out the money. The Enphase put hopefully will also expire out the money, and then we'll free up even more collateral, and then we'll basically be making our next moves for August lah. And so the most important thing for this portfolio right now is for you to hit the like and subscribe button so that you can continue to receive future updates on how I build out this portfolio. I'll be definitely looking to release weekly updates on the portfolio, and of course look to actually get into live streaming as well so that I can actually do my research together with you online, and then you can actually ask me questions along the way. But even before that, you really need to understand my thought process on how I pick companies, and I talk more about that in this video over here, and I'll see you in the next one.